How many times have you watched the price break a key level, entered the trade, and then seen the market instantly reverse? You assumed it was a fake breakout, stayed out of the next move, and before you knew it, the price had already exploded in the original direction. That wasn't random. It wasn't luck. It was a repeatable market pattern. And in this video, I'll show you exactly what was happening behind the scenes at that moment. In today's video, I'm going to show you a powerful price action strategy that's based entirely on the chart. No complicated indicators, just price and market structure. This strategy combines 4 key elements: liquidity levels, break of structure, fair value gaps, and one unique indicator that helps you separate real breakouts from fake ones. I'll break down each concept step by step using live chart examples. By the end of this video, you'll have a complete trading strategy that you can confidently apply in your own trading. First, switch to the 15-minute time frame. The very first and most important step is to identify liquidity and mark it on your chart. So what is liquidity? In simple terms, liquidity is the area where a large number of buy and sell orders are concentrated. The biggest pools of liquidity are usually found at the previous day's high and previous day's low. Why? Because traders holding buy positions often place their stop losses below the previous low, while traders holding sell positions usually place their stop losses above the previous high. At the same time, many breakout traders place buy stop orders above the previous high and sell stop orders below the previous low. As a result, these two price levels contain a massive concentration of pending orders. This is known as resting liquidity. Large market participants, such as banks, hedge funds, and institutional traders, actively target these liquidity pools. Since they trade with very large position sizes, they need a significant amount of liquidity to execute their orders efficiently. The stop losses and breakout orders placed by retail traders provide exactly the liquidity they need. So the first step of this strategy is simple. Every trading day, open the 15-minute chart, identify the previous day's high and previous day's low, and mark both levels clearly. These two lines become the foundation of every trade you'll take throughout the day. Now let's move to step 2, where we switch to the 1-minute time frame. At this stage, we're looking for 2 confirmations in sequence. 1, a liquidity sweep. 2, a market structure break, MSB. Watch the chart carefully. Price rallies toward the previous day's high and briefly trades above it. In doing so, it triggers the stop losses of traders who were short. At the same time, it activates the buy stop orders placed by breakout traders above the high. Then, instead of continuing higher, the price quickly reverses and moves back down. This is known as a liquidity sweep. Smart money uses the liquidity above the previous high to fill their large sell positions before driving the market lower. But here's the key point. A liquidity sweep alone is not enough to enter a trade. Many times, price sweeps liquidity, consolidates for a while, and then continues higher. If you enter immediately after the sweep, you can easily get trapped. That's why we wait for the market structure break, MSB. So what is an MSB? After the liquidity sweep, price starts moving lower and creates a swing low. When the next candle breaks below that swing low and closes beneath it, the market structure break is confirmed. That candle close tells us that the market structure has shifted from bullish to bearish. The market is now creating lower lows on the 1-minute chart, showing that sellers are taking control. This is the confirmation that smart money is actively pushing the price lower. Only after this confirmation do we have a valid bearish setup. In the next step, we'll learn exactly how to execute the trade. Now let's move to the third and most important step. How do we tell the difference between a liquidity sweep and a true breakout? For this, we're going to use 2 unique indicators. Look at the chart. This is the Nifty Midcap Index on the Dun platform. First, open the indicators section and search for doors. Add the doors box indicator to your chart. You'll notice dotted lines appear. Open the indicator settings and set the length to 20. Once you've done that, the indicator will automatically plot key levels on the chart. The purpose of this indicator is to identify range-bound markets and potential breakout zones. As long as the price stays between the upper and lower levels, the market is ranging. When price breaks above the upper level or below the lower level, it signals a potential breakout. Now, a breakout alone isn't enough. We still need confirmation that it's a genuine move and not just a liquidity sweep. For that, we'll use Dun's Kaufman Adaptive Moving Average, KAMA indicator. Search for KAMA in the indicators section and add it to your chart. Sell setup. Watch the chart carefully. Price first forms a bearish engulfing candle, followed by a shooting star. After that, the price closes below the comma line, showing that sellers are gaining control. This is our confirmation. Take the sell entry below the low of the rejection candle, place your stop loss above the rejection candle, and aim for a risk-to-reward ratio of 1-to-2 or 1-1-2-3. Now, let's look at the bullish scenario. Price forms a bullish engulfing candle and then closes above the comma line, indicating that buyers are taking control. Next, wait for the price to break above the doors level. Once price moves above that level, take the buy entry, place your stop loss below the bullish confirmation candle, and target a 1.2 or 1.3 risk-to-reward ratio. Now let's move to the most precise part of the strategy, how to find a 1-to-5 risk-to-reward entry. At this point, the market structure break MSB has already been confirmed, so the direction is clear. But that doesn't mean we should enter the trade immediately. We still need a precise entry point that gives us a tight stop loss and the highest possible reward. That entry point is the fair value gap, FVG. Watch the chart carefully. When the MSB forms, a strong bearish candle usually breaks the swing low. During this aggressive move, an imbalance is often created. Look at these three candles. The low of the first candle, the high of the third candle. The gap between these two levels, which the middle candle failed to fully trade through, is called the fair value gap, FVG. Price moved so quickly that this area wasn't efficiently traded. Markets often revisit these imbalances before continuing in the original direction. So here's what we do. Mark the FVG zone and wait patiently. After the MSB, price moves lower. Then a pullback begins. When that pullback returns into the FVG zone, that's our entry. Look at the screen. Here's the FVG. Price pulls back into the zone, and we take a short entry from that area. Where should the stop loss go? Place it above the FVG candle. If price moves above that level, it means the trade idea is invalid, so we exit with a small loss. Now let's talk about the target. For a short trade, target the previous day's low. For a long trade, target the previous day's high. Why? Because those levels also contain liquidity. Price is naturally attracted to those areas as pending orders are waiting there. Now look at the risk to reward. You enter inside the FVG, place your stop loss just above it, and aim for the previous day's liquidity level. Since the stop loss is small and the target is much farther away, this setup often delivers a 1.3 to 1.5 risk-to-reward ratio. One more important rule. If price keeps moving without pulling back into the FVG, skip the trade. Never chase the market because of FOMO. There will always be another setup. Now let's walk through a complete example. On the chart, we've marked the previous day's high and previous day's low. Price rallies above the previous high, triggering the stop losses of sellers and activating breakout buy orders. Then price quickly reverses lower. On the 1-minute chart, price forms a swing low during the move. The next candle breaks that swing low and closes below it. MSB confirmed. Next, we identify the fair value gap created around the strong bearish candle and mark the FVG zone. Price continues lower, then pulls back into the FVG. That's where we take the short entry. The stop loss is placed 2 to 3 points above the FVG, and the target is set at the previous day's low. Now look at the result. Price drops from the FVG and reaches the previous day's low. The stop loss was 15 points, the target was 60 points. That's a 1.5 risk-to-reward trade. A clean, high-probability setup built on pure price action. This entire strategy is based on 3 simple steps. 1. Mark the liquidity levels. 2. Confirm the market structure break. 3. Enter at the fair value gap. Practice this strategy in paper trading first. Every day, mark the previous day's high and low. Then observe how often price sweeps those levels before making the real move. That single habit will dramatically improve your understanding of price action. If you found this video helpful, don't forget to like the video, and I'll see you in the next one.